Have you ever been in this situation? You obviously see a bearish engulfing candlestick, you possibly take a short, put your stop loss back above those highs, only for the marketplace to come and take you out before then going in your favor. This is what we call inducement. And inducement is how smart money tricks retail traders to be manipulated. And in this video, I'm going to tell you guys exactly why does inducement happen. I'm going to show you guys how to anticipate inducement and put it in a way to where you're no longer getting faked out. Towards the end, I'm going to give you guys a step-by-step trading plan around the inducement model that I personally use for the last couple months that's actually doubled my win rate. And last but not least, I'm going to show you guys live trade examples of an exact setup that I took using this exact framework that made me a little over $3,000 in only 30 minutes. So as we begin, when we think about the markets, we have to think of it from the lens of manipulation. For the markets to go higher, it obviously needs liquidity to go higher. And for the markets to go lower, it needs liquidity to go lower. But how does it get that liquidity? And it gets that liquidity by what we call manipulation. So let's break down this depiction, right? For the markets to go higher, it obviously has to initially go lower. That's called our manipulation. So price opens up and it goes lower. Hundreds upon thousands of retail traders are possibly going short here, anticipating the marketplace to potentially reverse and see a downtrend. And those retail traders are then what we call liquidity, because most likely they put their stop losses back above these original highs. So the market opens up, it goes lower to trap those traders that initially went short too early, only for the price to go back higher to take those traders out and use them as liquidity to offset the long positions, right? For the markets to go higher or for you to buy, someone has to be on the opposing end selling it to you. Obviously, the initial short sellers, they're going to get faked out because they're seeing the markets go lower, thinking that's going to, continue going lower, only for it to reverse and then use them as a liquidity to take the markets back higher. So this is why we get these candlesticks where price opens up, comes lower to create that fake move or that manipulation before giving that real move back higher, reaching back above higher prices. And vice versa can be said for a sell model, right? For the markets to go lower, it first has to initially go higher to trap those traders and use them as liquidity. So the market's going to open up, it's going to see higher prices. Many traders are going to chase this higher because, right, a lot of people, right, they see the market's going higher. Obviously, it's going to continue going higher, right? No, because they don't have underlying context. Right, the underlying context was we were potentially bearish. So we want to see the markets open up and go higher to then frame our short. So as the markets go up and go higher, a lot of traders are chasing this only for the markets to go back lower, use those shares as liquidity to create a strong move in the opposing direction. Now that we understand the underlying manipulation within the markets and how the markets truly work, let's put this into a practical framework. Let's break this down even more when it comes to market structure. It's not always as easy as buy when the markets go higher or sell as the markets go lower, because that's exactly what they want you to think. Everyone would be rich if we just bought when it went higher and sold when it was lower. But we have to pay attention to these two things. And there's two parts within a price leg. First, we have the external liquidity, and then we have the internal liquidity. The external liquidity can be found at the extremes. So we have this extreme high right here, and then we have this extreme low. Basically the highest point within this price leg and the lowest point within that price leg. And then anything in the middle would be discounted as internal liquidity, which would be this internal low. An external point of liquidity can be classified by this simple framework. When we have a liquidity sweep and then we had this breaker structure, you can obviously see the marketplace opened up, it came lower to take out this original low. And after taking out this original low, we saw this strong displacement in the upside, breaking back above this last structural point. From this liquidity sweep and breaker structure, we could classify this as a strong low point. Since we know this is a strong low point, then obviously price is not going to come back down here. Most likely price is going to reach back above higher prices. This gets us into our first framework, which is the manipulation. So obviously when we see this liquidity sweep plus breaker structure, we don't want to be buying all the way up here. We want to be waiting for price to come lower to give that manipulation to then buy down here to continue the markets back higher. This is initially called our manipulation. And then next we have our inducement. Our inducement is very, very simple, right? We can obviously identify this was that original manipulation before seeing this push higher, and then price comes back lower to take out this low before continuing higher, right? A lot of traders could possibly see this as maybe a liquidity sweep up here, and then it came lower to maybe create a break of structure, and a lot of traders could possibly short here anticipating lower prices. But no, right? You have to pay attention to the bigger picture. The bigger picture was we had this liquidity sweep, then we had this strong displacement to the upside, creating this external low, right? This is still a strong low. Even though price came lower to take out this low, as long as price does not make an effort to come back below this low, price is still bullish. So obviously when price comes lower to take out this internal low, this is what we call an inducement. Any traders who went long right here, most likely they put their stop losses back below this low. And for the markets to continue going higher, it needs liquidity. So price is going to come back lower to take out those traders, use them as liquidity to then continue the markets back higher, just like we see right here. Market is not just going to open up, rally higher, and continue going higher forever. It has to make an effort to come back lower to gather additional liquidity before it can get that strength to continue going higher. Anyone who was long right here and didn't take their profits at these highs, they most likely put their stop losses right here. And anyone who shorted this thinking it was going to see a reversal back at these lows, they're also used as liquidity. This creates a usual strong reaction within the markets to anticipate higher prices reaching back above the external highs. And then this gets us into our trading plan. We want to identify our strong high and strong low points. Obviously, this is a bullish level of support. So obviously this is a bullish depiction here. We had this liquidity sweep, and then we had this strong displacement to the upside, creating that breaker structure. So obviously this was our strong low point, which we should anticipate price to not come back down here. Instead, price should come back up into the external highs, because as the market is in an uptrend, it's going to take out these original highs, and it should respect the external lows, but it can take out the internal lows. Manipulation is an A+ setup. Right, this is when we had that liquidity sweep and breaker structure, and we created that first move where price saw that drop lower into that fair value gap before continuing higher. Right, make sure whenever you're trading a manipulation, right, we get this liquidity sweep breaker structure, you take profits at most recent points of liquidity, like around this high. Because a lot of traders, they probably didn't take their profits at this high, put their stop losses down here, and price will eventually take you out. Even though this is an A+ setup, it does not offer the best opportunity in terms of catching really big ranges. So we have to be careful when it comes to taking profits. Next would be the inducement, which is an A+ setup. This is when you're buying within a level of support, plus there's a level of internal liquidity. The first setup was simply price opening up, coming lower into that level of support to find support to push higher. This was a good setup. But the second one, this one's even better, because price comes down into that same level of support, but it not only taps into level of support, but it also takes out this internal level of liquidity. This creates a much high probability move that creates a bigger reaction higher, right? And the two levels of support that I like to utilize is one, the fair value gap, which is very, very simple. It's a 3-candlestick formation where we have this first high right here, then we have the middle right here, we have the low of this third candlestick. So from the first candlestick's high to the third candlestick's low, price creates this gap here, which is identified by this separation, creating this fair value gap. Right, obviously this fair value gap is an inefficiency within the markets. So price creates this expansion higher. It has to come back lower to gather liquidity before continuing. Since this is an inefficiency within the markets, we should anticipate price to come back down into this level to find support to push higher. Like I mentioned before, price cannot just open up and rally higher forever, right? It has to come back lower to gather liquidity or fill in any inefficiencies before continuing higher. So let's say this was a bullish fair value gap right here. Price saw this expansion to the upside. Price leaves this bullish fair value gap. So obviously price is going to see a manipulation to come back into that bullish fair value gap to rebalance it, because this is a level that's inefficient. As price rebalances it, it's now efficient to then take the markets back higher. And then our next level of support is the order block. So an order block is very, very simple. It's the last up close or last down close candle before seeing a strong displacement in the opposing direction. In this case scenario, this would be a bearish order block. So we have this last up close candle before seeing this bearish engulfing candlestick to the downside. So obviously this is telling us that this is a potential level where a lot of selling pressure came in, right? Because obviously these big bearish engulfing candlesticks retail traders are most likely not creating those. This is what we call a smart money footprint. This is an area to where we can anticipate smart money is entering positions. So most likely, let's say smart money entered 3 million contracts at this position, yet only 2 million contracts were filled to take the markets lower. There's still a remaining 1 million contracts at this specific level. So once price comes back up into that level, price fills in those remaining 1 million contracts before going lower. That's why it's called an order block. This is a level to where it's a smart money footprint where we can anticipate a strong seller to be at. So once price comes back up into that level, that seller then sells again, continuing the market even lower. So it's very, very simple. Last up close candle, we see a strong displacement in the opposing direction. Once price comes back up into this last up close candle, this should be a level of resistance to where we can frame a short setup to continue the markets back lower. See, whether you're utilizing the fair value gap or the order block, these are two strong levels of support within the markets to look for this particular pattern. Hope you guys are learning a lot, and if you're still confused, don't worry. I'm going to take you guys to the charts, and I'm going to show you step by step to make sure by the end of this video you become a much better trader. It takes me hours to create these YouTube videos, so if you guys got any value from this video, make sure to take 1 second out of your day to click that like button and support the channel. As well as, if you don't know who I am, I'm Arkhamtrades. I've been trained for a little over 3 years. In the last 2 years, I've been able to become a full-time trader. And how I've been able to go from a beginner trader to a full-time trader in only 1 year is because I had a mentor in my life like my brother Spectrades, who's been trained for a little over 6 years. And that's why me and my brother Spectrades created Spark. If you're a struggling or beginner trader and you want me and my brother to personally coach you to becoming a much more consistent profitable trader in the next 6 to 12 months, make sure you guys click that first in the description, fill out the form, let's get to know you, and then book a free call to talk to me personally, seeing where you're at in your trading journey and seeing how we can help you become a much more consistent profitable trader. Now let's get back to the video. So we're looking at the S&P 500 here, and I'm going to break down this exact setup that I called live in front of all of my students using the exact same framework that I just taught all of you. The New York session is just about to open up here at 9 a.m. EST, and just before that New York session opens up, I want to create what's called a daily bias. Basically, we're utilizing what has happened before, where we're currently at, and where do we anticipate price to go next. So obviously we can see here that price saw this massive drop to the downside, taking out multiple levels of liquidity. And identify multiple levels of liquidity within the markets that it came lower and sharply took out. We can take note of this bullish fair value gap, which we can see price obviously came down into that bullish fair value gap to find support to push higher. Right? This is that exact inducement setup I talked about. We had this level of support and price came lower to take out this internal level of liquidity before seeing this break to the upside. So obviously seeing this liquidity sweep and then seeing this strong break in the opposing direction gives me the validation that this is a strong low. Now that I identify where my strong low point is within the markets, this makes it a lot easier, because since I know that this is a strong low because we had this liquidity sweep followed by this break in the opposite direction, right, with strong displacement, there's no reason for price to come back down here. If we look above us, we can obviously take note of this original high right here, note of this Asia highs right here. We can take note of multiple inefficiencies in liquidity pools all the way back up here, making our job very easy. So coming into our markets, I'm looking for buys. Already came lower to take a level of liquidity followed by this breaker structure to the upside. There's no reason for price to come back down here, but there's all the reason for price to come back up here. We have this high, plus inefficiencies back all the way up here. Multiple reasons for why this price should go higher. Now I'm going to go down to a 30-minute time frame. 30-minute time frame, we get a little bit more information. We can take note of this original last down close candle right here. This was a bullish order block. Like I mentioned, this was the last down close candle before seeing this strong push to the upside. So obviously, as price comes back down into this last down close candle, it should obviously find support to reach back above higher prices, right? So this is that bullish order block right there, as well as this is also a bullish order block. This is what we call a propulsion order block. So this was the last bullish order block. Price came down into it to create this last down close candle before seeing this push higher. So this would be a continuation of that prior order block. I hope you guys understood that. So we had this bullish order block right here. Price came down into it, found support to see the strong push higher. So this is also a bullish order block, keeping things pretty simple. This is our strong low point because this was the level that took out this level of liquidity followed by this breaker structure to the upside. I should not come back down here. Have this last non-close candle as a bullish order block. Level of support that price came down into to find support to push higher. Now we have this bullish order block right here. Into the markets, it would not be wise to just chase the markets higher at this high or even back up here. Want to wait for a manipulation. You can see the markets open up and come lower down into within this order block level. This would create the highest probability opportunity to reach back above higher prices. I'm going to go down to a 15 minutes time frame and wait for that 9:30 to open up. So I'm on the 15 minutes time frame here, and the 9:30 candlestick is just about to open up. See here, 9:30 opened up and we saw this immediate rally to the upside. Right, a lot of traders probably chase this, right? They see the markets open up, they chase it higher, thinking it's going to continue going higher forever. No, that's not how we want to be trading. We don't want to be FOMOing into these type of trades. We want to be waiting for that manipulation, right? We identified that order block down here at those lows as our high probability scenario. So I'm not going to chase this higher here. If price were to just open up, rally higher and go higher forever, then I would just miss a setup, right? Too many traders try to catch every single move within the markets, which is not about catching every single move. It's about catching the ones that matter the most. So I want to see that initial manipulation to come back into this level to find a level of support to reach back above higher prices, because this creates a high probability scenario to where I get in on a trade at the best area. It's too risky because the chances of price reversing on me and coming back lower is costly. You want to be buying within levels to where you feel the safest. Then we can see here 9:45 opens up and we see a massive drop to the downside. And this is why you don't chase the markets, because this is usually exactly what happens to manipulate you. You can see price comes down into that last non-close candle right there off of that 30-minute order block. And then we saw this strong rejection to the upside. Now we're going to go down to a 5 minutes time frame to get additional information. On the 5 minutes time frame here, this is a beautiful setup. As we can see, we took note of that 30-minute order block right there. Just within that 30-minute order block, we can take note of this original low. Right? Remember what I talked about. This is a level of internal liquidity. And you may be asking, how is this internal liquidity? Right? This was the external low. Right? This is an external low because this is the low here that tapped into this level of support before seeing this breaker structure to the upside. Right? It tapped into a level of support, plus it took out multiple points of liquidity like right here before seeing this breaker structure to the upside. So this is a level of external low, right? Where price should respect this low point, right? This was the previous low point, right? Where we had that, liquidity sweep. Then we had this breaker structure. That was the external low, which price obviously respected. Price came down into that order block, saw this breaker structure right here. So this is our next external low. So from this external low to this external high, anything within this range, like this low, and even this low, is a level of liquidity. Obviously, the markets come lower harshly to take out this level of internal liquidity, as well as we tapped into that 30-minute order block. So once we tapped into that 30-minute order block, plus took out this level of internal liquidity, we can obviously see this push to the upside, creating this last non-close candle right here as our 5-minute bullish order block. So this creates a very, very good setup right here, that if we can see price come back within this 5-minute order block, this would create a pretty good buy opportunity to reach back above these higher prices, which we can initially set our first take profit back above this original high right here, and set our next take profit back above this previous daily high, right? Usually about 80 to 90% of the time, price will usually take out previous daily highs and lows. And this was the previous day low, which we can see price did not take out those previous day lows. Since price did not take out those previous day lows, showing us that it's currently bullish, an easy level of targeting that price is most likely going to take out is the previous day highs. So we did not take out the previous day lows because that was the external low, right, which it did not come back down into. So obviously, as we find support here, we can obviously anticipate price is definitely going to take out those previous daily highs. Just play out here. Wait and see. Price comes down into that order block. Then we see this push to the upside, breaking back above this bearish for value gap. So obviously this was a bearish for value gap, should obviously be a level of resistance. But the fact that price broke above this level of resistance is indicating to me that price is underlyingly bullish, right? The order flow is so strong that it's breaking back above bearish levels of resistance. This is a great sign that you want to look for whenever you're taking your trade ideas. So this gives me the confirmation to put my entry back at break even, because once price taps into this order block and then leaves it, it has no reason to come back down here. So I could put my entry back at break even, and I can potentially even scale into my position back above these highs right here. So I could scale into my positions back over these highs, maximizing on my overall reward. My first entry back at break even, and I adjust my new entry right here by the scale in just back below this low. So I end up risking a lot less on this trade, but I end up making a lot more. You can see here, price sees this push to the upside, goes back inside of that inversion fair value gap, perfect. Price comes back into that inversion fair value gap for a second time. Then we finally start to see kind of higher prices, taking out that first area of take profit. And then coming into the PM session here around 2 p.m, finally taking out those previous daily highs right there. Hope you guys got a lot of value from this video and this entire lecture. Some of the biggest key takeaways from today was obviously being patient, right? The market opened up and saw this immediate rally higher. You don't chase it. You be patient and you wait for that manipulation, because that manipulation usually creates the best opportunity to buy. When the market's going lower, you want to be buying as it's going lower. This gives you the best opportunity. So we saw that manipulation to take out this internal low, as well as within this bullish order block. Seeing this particular pattern here with this rejection wick, right, followed by this bullish engulfing candlestick here, after taking out that internal low inside of that order block, this is a great confirmation that price has found support at this level. And obviously we utilize this last stop close candle as a level of support to reach back above higher prices. And if you guys want one-on-one coaching where me and my brother will personally help you become a much more consistently profitable trader within the next 6 or 12 months through one-on-one coaching, daily live trading, a full-on curriculum, and much more to help you become a much better trader, make sure you guys click that first in the description, fill out the form, and then book a free call with me or my brother Spec Trades. Let's get on the phone, see where you're at, and see how we can help you along your trading journey, as well as comment what you guys want to see next. I'm your mentor, Arkhamtrades. Be safe.